Begin, though, with our talk of the tape. Now what? After another CPI report shows inflation is cooling, the Fed's still talking tough today, but stocks rising anyway, especially into the close here. Is it a sign to get more positive on the markets? Let's ask Liz Ann Sonders. She is the chief investment strategist for Charles Schwab. Welcome back. Happy New Year. It's nice to see you.
Happy New Year to you, too. Thanks, Scott.
All right. So what do you think about the report today and the way stocks reacted here?
So I think it was less about the headline. Pretty much every metric that came out in the release was in line with expectations. I think what generated a lot of enthusiasm were the variety of 3-month annualized trackings that people calculated on everything from just overall CPI, core CPI, and in particular services X rent, where that 3-month annualized move now has a one handle on it. So even though a metric like OER, which is an imputed value, is not yet following the real economy metrics like Zillow or Apartment List or Redfin, it's coming. It may not be in next month's report. So I think it's that look ahead, and the trend move down highlighted by the 3-month annualized change, I think is probably the basis of the enthusiasm we're seeing today.
Yeah, you know, you're starting to hear that G word, Goldilocks, right? Fed near done, inflation cooling, economy holding up. Maybe it means soft landing. You agree or disagree with that?
It may be a little bit, Pat. I think that right now, anyway, the Fed is to some degree fighting the market. It's not really that the stock market is fighting the Fed. It's the bond market sending a very different message than what the Fed is telling us. Either that the terminal rate is going to be lower, or that the economy is going to be weaker, and hence the steep, the sharp inversion in the yield curve. And I think the stock market is sort of following along with that somewhat benign message coming from the bond market. But we don't yet know whether the Fed is ultimately going to heed the market's message of 1 or 2 rate cuts happening. Our contention has been all along that, based at least on what the Fed is telling us, that the conditions under which the Fed would have a green light to pivot to actual rate cuts, not just pause, probably is a steeper deterioration in the economy, and in particular the labor market. So how we skate through and maintain a Goldilocks environment and what that means for financial conditions probably means the Fed's not done yet. So I'm not sure that neatly fits into the Goldilocks narrative. And the greater tendency is historically is for the Fed ultimately not to buck the message of the market, particularly if the market's message is quite consistent and in line with the economic data. I just think it's premature at this point to make that call. In addition, we can't really look at, say, the past even 30 years as a proxy for what the Fed might do. Is it the market that's more powerful than the Fed and their rhetoric? Because we're dealing with 70s era type inflation, and the Fed knowingly behind the curve and maybe willing to risk going a little bit too far. But I do think your point is right. Jawboning, rhetoric, forward guidance, whatever terminology you want to use, they know it's a powerful tool, and they're using it at this point to kind of go against what the market's saying. Ultimately, what they do will probably be very much driven by the market, but it's almost more of a fine-tuned instrument than just the more blunt instruments of actual rate hikes or balance sheet shrinkage.